Good evening, everybody. This is Jeff Scott. It is late. I was at a cool meeting this weekend, which I'll talk about. Great meeting. So it's 9:45 about on Sunday Eve. I did this title back at about 1 in the afternoon when I defined my thought of the market as hidden strength with news pending. The reason why I say hidden strength is the last couple of weeks when I've done my chart reviews, it's been hard to find great patterns. And I was astounded how many stocks I saw that were starting to set up for the types of setups I like to take. Didn't really make sense because all I got to do is watch TV and the world is ending and we're going to have a fascist in Paris and the market's going to be kind of like Trump, we're going to roll over and fall. But as I looked at charts, that's not exactly what I saw. So you have to trust me that I did not come up with that this evening, but came up with it before the Paris elections. Just to cut to the chase, probably everybody who's viewing this is well aware that for a bull in the U.S. market, we probably got the exact outcome we wanted, which was it was pretty much expected that the right-wing fascist woman would get her would get one of the two for the runoff. A question: who is going to oppose her? And it looks like it's going to be the centrist candidate. And not that I know anything about French politics, but they had a left, a center right, and a right-wing person running. I doubt the left and center left are going to switch to the right wing, and the right center is probably up for grabs. So I think there's a good chance that this political novice in the center who wants to stay in the euro, keep the euro currency, is going to win. Has a good chance of winning, and hence you can see the futures are up big. This was going to be a binary event. Obviously, there's more things that can occur. So, all right. So for those of you that I met this weekend, and this is your first time watching, welcome. I'm just going to say this right now, and this goes to anybody who reviews my videos. You see my email there. I get no commissions. I get paid nothing if you buy anything, and I like it that way. In fact, I turn down marketing fees or different things because I think that biases me, and I don't want to be biased. I have a video and a presentation PDF that I gave that sort of goes through my process, how I think, what my indicators are, what the funny names are. It's about a year old, but I think it's very good. So if anybody emails me, they can have that. If you're playing with HGSI and you'd like to get some more in-depth instruction of how to use it, I also have a 6-pack of videos, and I'm very happy to share those with anybody who asks. So let's take a look at what I saw. Disclaimer: this is for education purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I am an unpaid, unsponsored volunteer. I'm independent. No one pays for me to do these things. No one pays for me to say things about their product. And trading involves risk, and you alone are solely responsible for any investment decisions you make. I will talk about trades I take, trades I might take, how I might manage a trade, whether it's a stock or an option, and so on and so forth. But that should solely be considered educational. I am not going to recommend a stock on this webinar. I probably will talk about certain stocks, but I'm not going to recommend one formally because I have no vehicle to call you up and tell you, hey, I'm selling mine now. So the last thing I want to do is have people base decisions on what I or any other person says, unless that person's going to tell them when they close their trade. So you're going to notice a change here. And I'm going to talk about I should have made it bigger before I did this, so I meant to make things a little bit bigger because I don't want it to seem small because it's insignificant. So as you can see, and those who've been here before know that I really started out as a CanSlim trader. Still follow CanSlim, although I'm not like Lee or some of the other IBD gurus that are out there, and that I don't use the 31 cell rules or 50 cell rules. But I do like growth stocks, and I like to buy stocks that have earnings per share and relative strength in appropriate setups, and then buy them when momentum comes in. And that's a lot of what CanSlim's about. CanSlim was brought out by William O'Neill. Morales and Catcher are actually people I've had a chance to get to meet personally, great guys. And they've taken what they learned from O'Neill and built upon it with pocket pivots and Bible gap ups. And you'll hear me talking about those. The other folks above this, let me get back there. This is Ian Woodward, may rest in peace, who's just a brilliant guy from England who came over here as an adult, worked for Xerox, and he too was a student of O'Neill. And not only did he make O'Neill stuff make more sense, he improved upon it. And then he got together with George Roberts of highgrowthstock.com and created HGSI, which is a tool I like to use, which is really not about growth stocks. It's really not about growth versus value, technical versus fundamental. It's just a great platform. Of course, we use it to find growth stocks. Ron Brown, who was Ian's partner, still actively involved. In fact, he has a totally different style of investing than I do, and he's a big fan of volume spread analysis. Now, I found that CanSlim was a great basis of understanding how to trade, money management, sort of the what to do and when to do it, how to do it. But I'd probably consider that my undergraduate degree at best. The master's and doctoral degrees are the guys on the right who basically have helped me take what I've learned from the basics and from reading and how to turn them into action. Very different styles between the guy on top, John Person, and the guy down here, Guy Cohen. John, as I've mentioned before, is a close friend of mine now, but I started out as a customer. He's a mentor, a teacher. He designed software. He's just been trading forever. He's about my age, and when I was doing my medical school internship and residency, he was learning how to trade from the guy, from George Lane, who developed stochastics, and he's been a trader ever since the 80s. And I follow him closely, and he has helped me sharpen when I take the trades and how to manage them. A lot of people talk to me, they say, Jeff, what you do is interesting, I don't have time. Where are the shortcuts? How can I learn how to be a good trader without necessarily buying $5, $10, $20,000 worth of software? Is there something I can do to make my life easy? And in that vein, I started following this guy in the lower right-hand corner, Guy Cohen. And this was my first time this week of actually meeting him face-to-face. And I actually went to one of his options seminars down here in Miami. Guy has, just from my gestalt, he looks like he likes growth stocks. He likes specific patterns, flags, pennants. What he likes are stocks that are in uptrends that pull back to support, and then he uses his proprietary indicator of when to take the trade. Those who've been with me for a long time know that cup and handle, that's a pullback. And then a handle and a breakout. John Person's buy signal 2 is a pullback to pivot support, and then a breakout with momentum. And Guy Cohen uses a thing called OVI, which is very proprietary. I've tried to figure out what's in it. It's something to do with option trading, volatility contracts, validated by quants, as he educated us, but really looks for where are the hedge funds buying and showing activity. And he's got a couple of websites and tools that are called trade finders and help to find trades, whether you're looking for a stock trade or an option trade. And, I have to admit, and I told him to his face, I thought initially the websites were kind of quirky and it was kind of a gimmicky story as I listened to some of his marketing webinars. But I put him on the page for a reason, because he just made it to the people that I now want to follow closely. And I think I can learn even more from him. And it's not a quirky and it's not a gimmicky tool. This OVI is very interesting, and I hope to learn more and more about it. I've used it for a while as a confirmation tool. And the other thing that happened this weekend is I got to spend a lot of time understanding his websites and the various trade finders for finding flags and appropriate options to use. So something to check it out. And enough of that. George Lee, most of you know, is a friend of mine and a person that I've shared podiums with giving talks. And then Van Tharp, sort of the god of position size and money management, who in his book makes the argument and proves it that it doesn't matter what stock you buy. Doesn't even matter what your entry was. It's how many shares you bought, where your stops were, and when you got out that matters. So money management is king. I own almost every program out there. So I have wasted a lot of money. What I really need are TradeStation Thinkorswim, HGSI, and EdgeRater. And again, I update as thing goes on. And now I think I'm going to spend a lot more time with flagtrader.com and optionseasy.com. So again, I continue to expand what I use, but at the same time, I've actually dropped a lot of the tools over the years that were things that I thought were important, as I either could replace them with other programs or I found that they didn't give me an edge. As I said, I don't get paid for these programs. I don't get any promotional fees, but what I do get is access to the proprietors, and when I have a question or a request, I often can get things that I want added to the program. Here's the website for HGSI. As you can see, it's a free 30-day trial. If you go under investing strategies, you could find hundreds of videos that I've done on a weekly basis. Also, Ron Brown has some great videos when he talks about VSA. So, one of the things that I did say to Guy this weekend was, you spent a lot of time looking at right options to buy, sell, talked about the Greeks. And, what I liked about Guy's work was it was very practical, similar to when I work with John Person, very practical. One thing that I would fault Guy, and I think it was just because this was a specific program about options, is the most important thing to me is what my underlying does, which I think Guy said the same thing, is it's all about the underlying. And what's going to influence that underlying is going to be the market. So I always start with the market. And, it's funny because when I woke up this morning, I would have put us here. And I certainly felt like, and everybody you listen to will tell you that we're toppy, we're heavy. This time it's it. A lot of bad news coming. We're going to roll over. Then you watch at 6 o'clock when my futures come out, it looks like we're down here and everything's all on board. I think what it is we're just still stuck up here in a trading range until we break out above or below. Maybe today will break us out. The NASDAQ did hit new highs last week. So if we can get confirmation, maybe we do see another leg up. Obviously, we've got the sell in May crowd that are pointing out that it's April 23rd today. So May is not far away. So things happen quickly in a news-driven market. Hence, you have to, where do you fall and how you're going to manage your portfolio. I have been sitting up here. I have raised cash, smaller positions. I have sold some premium. I've taken profits. I have less positions today than I did last Monday. I'm glad I took off most of my shorts, especially on the volatility side, as the week ended, some of them because they expired worthless, unfortunately, and some because I don't know. As I said, I looked at a lot of stocks and I thought we had some good setups. I still have some puts on some of my holdings, and I had some puts on some stocks that I thought were overvalued, but I'm still very much net long, but not as long as I will be if this market confirms that it's a new uptrend. Friday was not a great day for the bulls. It was kind of a mixture here, and this was a week where one day up, one day down, one day up, one day down, and one day up was how my portfolio basically went. And I outperformed the S&P, but I didn't outperform the IBD 50, and I'll show you that at one point tonight. But if I look at what was working at end of day on Friday, I apologize, I'm using a different mouse, and whatever reason, it's just going crazy every time I move it. Home builders performed well. Some of the industrials did well. Utilities did well. Despite some of the bad press, the airlines had some strength. But you look at what was not doing well. Financials are still code red. Energy, which is in here. Interestingly, some of the XOP, despite falling oil, were positive, including Devon and Marathon, among others, but just a little bit positive. And healthcare was weak. I thought biotech was going to set up last week, and biotech and healthcare in general were very weak. Now, when I look at the major markets, it's sort of the weekly and the daily show almost totally different pictures. Now, for those who haven't been here before, the upper left is the E-mini futures, the center are the NASDAQ futures, NASDAQ 100 futures. The upper right are the Dow futures. The lower left is the IWM because some reason the Russell wants to charge so much for their futures that Thinkorswim dropped them, which makes it hard to trade them, which will hurt the Russell, but who knows. So this is the IWM, so it's only in the day markets. The others are 24 hours or whatever they run. I think it's a little bit less than 24. The VIX and then the dollar. So you look at these and what do you see? You see in green 17-day moving averages that have pretty much crossed over or about to cross below the 50. So that's a bearish tone. And for the most part, the E-minis, the stocks close below the 50. The NASDAQ 100s between the 50 and the 17. That's probably the strongest as the week ended. The Dow rolling over more, closing below the 50 and the 17. And the Russell also having a better week than the big stocks, breaking above its 50-day moving average. The VIX higher than it was a couple of weeks ago, but it's come down on the week. And you can see the dollar has dropped as well. That's the daily. Now I looked at that and I said, I shouldn't feel very bullish, should I? Then I looked at the weeklies and I said, wow, this is my setup. I got uptrends, pull back to the 17. Uptrend, pull back to the 17. 17 weekly is about the 50-day moving average. Uptrend, pull back to the 17. Uptrend, pull back to the 17. How can I be bearish when all four major market futures are in big uptrends and shallow pullbacks to the 17 weekly average, and the 17 weekly is above the 50 and above the 200? That made me perk my ears up and say, And then I look at on the VIX. The VIX came down this week, and the dollar is was in sort of nowhere land, stuck between the 17 and the 50 weekly moving average. So again, as I looked at the daily, I'm trying up here, I see indexes that look like they're rolling over, and yet on the weekly, things still look pretty strong. So maybe the bull is not dead yet. Here's just another view where I'm using Genesis, and these are columns. And the first column is the E-mini, second column is the NASDAQ, the third column is the Russell, fourth column is NYSE, and the fifth column is the YM. And the top row is daily, the second row is weekly, and the third row is monthly. So if I look down at monthly, everybody's in an uptrend, easy to see. If I look back at weekly, everybody's in an uptrend. You'll notice some orange triangles, which means person sell signals on the weekly on the E-minis, the NQs, the TFs, the NYSE, and the Dow. So at least in the Genesis software, all the major indexes do have a weekly sell. That can't be good. But the dailies here are sideways, except for the NYSE and the Dow, which are down. So again, short term ugly, but longer term still in uptrends. Now, I like to look at some of the underlying. What are rates doing? Now, to me, there's probably a magic line. I don't know if this is 2.5, 2.6, whatever I came up with years ago, that as long as interest rates are between like 2.5 and 3, I think the markets can do well. And that when the interest rates get very low, it might be good for REITs and MLPs, utilities, dividend payers, and home builders. But you get to a point when the rates are real low that there's concern that something's going on with the economy we don't know. So I've been sort of perplexed over the last month, and I've called out several times that, boy, both the 10-year rates and the 30-year rates have been falling despite what we think is a strong economy and a Fed tightening. That tells me the Fed's going to tighten less, or the economy's not as strong. There's fiscal concerns with the White House. I don't know. but I think that is not a sign of happiness for the U.S. market. Now, rates that rise are good for banks and insurers, so with falling rates, banks are a little bit more challenged. Now, one thing you can't see very well, I got small stocks on the left and big stocks on the right. Yellow, just for a marker, is the S&P 500, and white is the AD line on the two underlyings. And you can't see it, but you had a pretty good up move or on the higher highs on both the small and the large stocks, with the small stocks really making a big improvement in their AD lines. Other signs of breadth. This here is the percentage of stocks above the 200-day SMA. Historically, this line had been a place where the market liked to turn, and as long as we're below that line, the market likes to go higher, so we're below that line. We're in the middle from a breadth perspective. And on the 40-day SMA, we're right in the middle. So, this only helps me at extremes. We're not at an extreme right now. The 3-month new high, new low. Last week, I talked about how we might be nearing an inflection point because we were getting near the low of the 3-week or 3-month or 13-week new high, new low ratio. And not only did the market turn around a bit, but we rebounded back to the middle. What I found with this is it's hard to know exactly when it's going to reverse, but when this reverses, usually the market follows up. But I look for it to get up near the top because I've gotten some pretty good reversal opportunities in the market as it's hit this way overbought indicator on the 13-week or 3-month new high, new low indicator. The McClellan, I'm not a McClellan expert. I look for divergences. I look for obvious things. So what do I see here that is interesting? The daily on the oscillator is above the midline or 0, while the Summation index is lower. But now, notice we're getting a higher reading on both of these. We had a lower low here, higher low here. Haven't had a chance for a higher high. So there were divergences suggesting worsening breadth. So perhaps this move down in the market has eased some of the divergences, and here you can see similar on the weekly. So I do this to help me judge where I think we are in the market and to look again for the extremes. The buckets. So for somebody who's new, this is an Ian thing. And EdgeRater is a wonderful tool that automates a lot of these tests for me. And imagine if you could take every stock in the S&P 1500 and put a chart for each of those with Bollinger Bands and be able to tell on those charts where your stock closed within the bands. Were you above or below the midline? And then since you could range a Bollinger Band from 0 to 100, which is the percent B, and if you told me the percent B was 7, then I know it would be in the lowest decile, the lowest 10% of the bands. If it was 95, it's at the top of the Bollinger Bands. And then I can add a decile for below the Bollinger Bands and one for above. And what I do is I run all S&P 1500 stocks. It takes about 3 minutes. And what do I find? I found that today, 65% of the stocks in the S&P 1500 were above the midline. That's a big change from the last couple of weeks and is a bullish indicator telling me there's more strength in this market than I was seeing. The other thing I see is I've got more green, which means I've got more stocks that are in buckets above the midline, but more importantly, I don't have 20 or 30% of the stocks above their Bollinger Band. If a stock is within its Bollinger Band, say 90% of the time, that means 5% it might be above, 5% it might be below. And I find that 40% of the S&P 1500 is trading above their Bollinger Bands. It's pretty sure there's a rubber band signal there that this market's coming down. And vice versa, where a couple weeks ago, even last week, I think we had 10-12% of the stocks below the lower band. That wasn't enough to give me a signal. Usually I look for 20 or 30%. But again, at extremes, these buckets become extremely helpful. Right now, that just tells me we're in a bullish trend here, which is a change over the last couple of weeks. Again, underlying strength despite the talking heads telling me the market's going to fall soon. The Hindenburg omen. Maybe this is voodoo, but the Hindenburg omen is a mathematical analysis that looks at new highs and new lows, their ratio, their number, the McClellan oscillator, and the weekly average of the NYSE. And when you hit 4 signals, then you trigger a Hindenburg-Omen sign. Now, why does that matter? There hasn't been a major market correction in 50 years that wasn't preceded by the Hindenburg-Omen. The problem is only about 1 or 4 are meaningful, and there hasn't been a major correction without one, but you get a lot of 2, 3, 4% pullbacks. You don't always get a major one, but I always like to go back at 2007, 2008 and ask you what you would have done differently if you knew about the Hindi. Market tone, I pay attention to this column where my arrow is, and this is an indicator which is calculated by the percent B times bandwidth on the major indexes. You don't need to worry what they are. They're all the majors. All I can tell you is we're still in chop. Now, you'll notice that one of my indicators that I use is called the Kahuna. It's a momentum indicator. It's a percent B change more than 24%. A dark blue or dark red would mean 40%. And we did our quantitative analysis and found that a 24% move was rare. Not, you saw several during the year, but a 40% move was a big deal. And so we look for those big moves, and we found that they usually correlate or often correlate with a change in market direction. Case in point, if I go back up to last year before the election, solid red here in the markets. Markets are selling off, and we had 2 volleys of blue kahunas occurring in most of the markets, and that reverted us from a sell to a buy. Here we were in a good market, and then we had some chop, and then we had kahunas to the downside occur and put us into a sell signal. Well, we've now had 2 sets of kahunas, and we're still in chop, but I bet if this holds up what we're seeing, and if being the world's largest 2-letter word, that we may see this market tone become much more bullish, at least for a period of time. And then I look at the sectors, and you have the S&P sectors across the top. I know it's hard to read. And again, just look Gestalt, where we now have 2 red ones, where a couple days ago we had many more red ones. Doesn't mean anything. You can see that multiple sectors have had upside kahunas as well, but it's less bad than it was a week ago. So improved slightly. And then one of the other things I like to get a sense of what the market is doing is I create surrogate indexes. And you could argue that this chart here looks a hell of a lot better than the market. And in fact, here's a list of the stocks that are in this list. Originally, I had LinkedIn. I took LinkedIn when it got acquired out and put in Baidu. And this is a canary index. And, I think they take canaries into the coal mine because they die before the miners do, and they give you a signal that you need to get out. Well, we use canaries in the coal mine or canaries in the market for the same way, with the knowledge that we'll usually see the canaries, the big stocks, roll over before the market does. And when I see the canaries are sitting at the 17-day moving average, had a kahuna, which is a momentum move to the upside that I've mentioned, 17 above the 50, above the 200, that is extremely bullish. And I have a buy-sell signal that I was involved in, and it's basically, you can see it's green across the top, and that's the weekly, we call it the bongo, and you could see it was a good signal here, and it's not fast, and it won't get you in first, and it won't get you out before any damage is done, but it keeps me in for most of the run, and that's in a solid green. So I look at this, and my canaries want to go higher, and if that's the case, maybe the markets aren't going down like everybody says on TV. This is an incredible week for multiple reasons. The economic calendar out of Bloomberg is right here. Reference is right there. And then these are some of the earnings. This is a huge week of earnings. Halliburton on Monday. Tuesday, Caterpillar, CMG. Well, Freeport-McMoRan, Lilly, Coca-Cola, McDonald's, U.S. Steel. Wednesday, Boeing, Twitter, Buffalo Wild Wings, PayPal, Seagate, Procter & Gamble. Thursday, Bristol Myers, Celgene, Potash, Under Armour, Google, Amazon, Baidu, Intel, Microsoft, Starbucks. Don't you think this is going to be a fun day in the market on Friday? Because most of these come in after hours. And so here is a quote that I made. If somebody else has made it, I can assure you I never read it, but it just makes sense. It's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. One of the things I like about Guy's program is he has earning dates on all of his screens and highlights them like I did here in red to call your attention to them. Market thoughts. Again, this all came out prior to the futures, and the market can still roll over. I thought breadth was improving and growth led this past week. I still got to show you that proof. Huge week of earnings reports will drive volatility. News may trump. No pun intended. French elections, we can check that off on the green category. Will the healthcare bill be revisited? If ACA gets turned down, hospitals and anybody that sells things that are paid for by insurance companies will get hurt and insurance companies go up. If ACA is maintained, it's the opposite. We have a federal debt limit that has to be renewed. All the information I'm hearing says it will be passed by the end of the week. We hear about the tax plan on Wednesday, which I'm sure will be a disappointment, but at least there'll be some talk about it. And then we've got North Korea, and you've got that crazy fat guy who all he's got to do is potentially hit a button and our market will implode. But so will his entire country, so hopefully he'll be smarter than he sometimes acts. Last week was a good week for growth, but need more data points to see that a trend resumed. The bullish case, and this is again pre-futures, improved breadth, orderly pullback of major indices into 50 weekly moving average or 17 weekly moving average, which is the 50 daily. Change that. No HINDYs. Bearish, they're struggling at key daily resistance. May is coming, and the news and EPS dates may kill you. As always, I'll do my top-down review, and this usually takes about an hour, although I hope to get done quicker. But since I'm talking more, we know that's not going to happen. So I did mention last week. So the report I'm going to show you is cheating. It's cheating because it doesn't take into account whether a position's long or short. It doesn't take into account if I have hedges of its stock or its options. But if I take the stocks that I own, or I owned on Friday the previous week, and same thing with the stocks in the IBD 50 and other scans, it just tells me how they would have done in equal dollar positions had I held them the whole week. And why this is important to me is even though I don't know that I even have half the stocks that I had a week ago, it gives me a sense where my universe is compared to the markets. So the first thing I notice is there's a lot of black, and there's more black than red, so more positive than negative. The S&P on a flat line. From end of day Friday to end of day Friday was basically the same. While the S&P was flat, some of my growth indexes, the IBD 85, which is the weekend review on Friday, was up 1.29%. The IBD 50 was up 1.43%. The HGS 100, which is more like the HGS 50 because not enough stocks are making the screen, was also up. Those are three growth-based indexes. If I took that loose index on mine, I was up a little bit. Again, it's not realistic, but it shows you whether or not the kind of stocks I look like are above or below the market. And the stocks that I was interested in buying, although I had more positive than negative, they were down a little bit on the week. Don't know if I actually bought them. What strategy was working? Pull back to a moving average with momentum. That's the strategy I like. Now, the interesting thing is 2 out of 7 were positive. That means there were 5 losers. They were still up 2.82%. That must mean that there were some big returns. So Immunogen was up 26%. Diamond Rock was flat. And the reason why this was so positive, despite the fact only really one of them were up, was because of the percentage change being so small on the losers. Viable gap ups, these were two of the ones that I liked that occurred on Friday. And the point of these is that, and these were picked, before the market opened the following Monday, that viable gap ups, these are Morales and Catcher tool, often continue to perform well, and you could see they're up. One of them was up another 5%. All right. So I know growth was in vogue last week. Now what I like to do is I like to start looking at the markets. I open up my warehouse view. This is HGSI for those that haven't seen it. Think of it as a giant spreadsheet with pivot tables and all kinds of fancy searches, scanning, and tools to rank things. So let's just look at the major market indexes. And let's look at a pure price and volume filter, and let's rank them by really one-day performance for about 80 to 90%, then a little bit for 5-day performance, and just a little bit for 3-week performance. And that shows me, using this, and make sure I rank them the right way, that gold and mid-caps, transports, and NASDAQ up at the top, small stocks at the top, oil, biotech, commodities, gas, and big stocks with the S&P 100 and 500 at the bottom. There's also sort of a disconnect between gold miners and gold. So we'll take a look at that. Now, in a very bullish market, you get the NASDAQ, the Russell, the Dow, and the NYSE in the top 4 positions. In a bearish market, you flip that to the bottom. Here, we have some strength in the stock market, but really a lot of weakness in the commodities, especially oil and gas and silver. So then I like to now open up and look at a couple of these very quickly, and I'll review a couple of things that are on my charts that might be new to you. Again, you just have to reach out to me and I can share with you the secrets of what goes in the charts. So, very quickly, we go into a simpler view. Here we have the S&P 500. We have a daily chart, which unfortunately this is in the way, but trust me, it's a daily chart. I wonder how I can get around that. This is a new thing that's in. All right, well, I'm not going to try to get around it because I'll mess it up. It's a daily chart, and it's looking at the S&P 500. Excuse me one second. Sorry about that. I'm back. So here's the S&P 500. Let's clear all the work that I've done with this. So let me just tell you about my charts. The first thing is that bongo indicator. The bongo indicator is something I developed with a couple of my friends or colleagues a decade ago. In the information that I'd be happy to share with you, I define what goes into the bongo, and it really has saved my bacon on multiple occasions. Again, the caveat is it doesn't always get you in early, and it doesn't get you out early. However, let me just close my door. However, the reason why I use the bongo is to keep me from major market pullbacks and how I use it with other signals. The other thing I do is the long-term trend is determined by the weekly bongo, the short-term trend by the daily bongo, and when I'm in the setting of a long-term green and I get the red dailies, it's identifying pullbacks in the market or in the index or in the stock. So it gives me the opportunity to perhaps jump on board during a pullback. The next two are two different versions of the HINDY. It's the same program, but there's been some data changes from the vendors that supply HGSI, so I use two different vendors worth of data. Now, a spurious HINDY doesn't mean a thing. Let's go back to 2007. Imagine I had told you that when you see these riddle red lines, that they mean that the market is at high risk of running over. And you're like me, and you were sitting in Europe at the time, and you're minding your own business, and the market pulled back hard, 50 points, so 3-4% pullback into the 50-day moving average in June. held at the 50-day moving average, not too bad. Notice my Bongo weekly is green here, so I still want to be long the market. Now, a couple of things have changed. We've hit the 50 again, and we now have had 2, 3 Hindenburg omens fire in a short period of time. Down here, those kahunas, those momentum, those movement within the Bollinger Bands have fired to the downside. This was a clear-cut signal to get out of the market. Now, it turns out that the first leg down wasn't so bad. So the next day we closed below the 50 and failed at the 50. And we came back up. You got your another shot, another Hindi. You're still in a weekly Bongo red, kind of choppy. And then, boom. So you saw 1, 2, 3, 4, 5, 6, 7 Bongos in the period of about 4 weeks, and not Bongos, rather 7 Hindenburg omens, and that should have told you to get out. And whether you took the first series when it broke below the 50 or here, had you gotten out before it dropped below the 50, you would have saved pain. Then you would have seen this bar and said it's okay, time to get in, but watch my weekly Bongo, it's going to be slow, and that's one of the problems. So I don't always say no if it's red, but I don't like getting into things unless there's a good reason. So we're turning back down, and now we're going to break above the 50. We had a kahuna come in here to the upside, so now I've got momentum back to the upside. I have these things here. Green is good, it's a Eureka. Red is bad, is a Phoenix. And these are the our electronic calculated version to imitate the follow-through days of O'Neill. Now you're back long, your weekly Bongo turns green. And wouldn't it have been nice if I had that OVI indicator guy here to see what the market was telling me? And you had a nice little run here until. So now, you may have missed it the first time. You got 3 Hindis in one day. You trace back up here, you made a lower high, more Hindenburg omens, you broke through the 50. I was sitting in India, and this was the day that I had to get out of the market. I was late on the second run through, but it was confusing because you had a major rally here in a red Bongo time, and obviously market's trying to recover here, but you're still in a clear downtrend. My weekly Bongos are keeping me out as well. And the rest is history until we got to that lovely period in March of 2009 when the market actually will turn around and rally. You notice you don't see any Hindenburgs because you don't get Hindenburg omens unless the market has gone up. Think of the Hindenburg omen of measuring that period of time where there's a lot of entropy in the market, lots of new highs, lots of new lows, and the professionals are selling their positions to us. And that's a time where they're getting out and we're getting in, and the professionals are the ones that are correct. Notice the number of Phoenixes to the downside compared to Eurekas. So the market is toast, and I have other tools I use as well, but the first clue to get back into this market, besides this little blip here, is going to come in March of 2009, and very early on with 2 dojis, and then the Phoenix, or the Eureka rather, and then the rest was history. Had you been a Bongo trader, you would not have gotten back into 805, but then you would have stayed long for quite some time. And notice as I go forward to date, you don't see Hindi omens. So we have seen a few of them over the last couple of years. But I don't get nervous until I see more than one occurring within a week or so. So I'm on Hindi watch, but we don't see one. Here's my stock prices, and this is a 17-day simple moving average, a 50 simple, a 200 simple. The magenta is an 8-day exponential. Again, this is my kahunas, which is a momentum indicator. Blue is good, red is bad. And the next box down are my market follow-through indicators, green being market turnaround to the upside and red would be concern to the downside. And when you see a pullback to major support, a momentum indicator and a market improvement indicator, I don't wait for my bongo to turn green to get back in. So we get to where are we today? So we're sitting right around this confluence of these moving averages. My daily and weekly bongo are red. We had 2 kahunas last week. As I said, we had up, down, up, down, up, down. And that's interesting. And that was part of what suggested to me that we had some underlying strength. Now I'm going to have to play a little bit sizing game here. I don't usually use this monitor for my presentations, but since I just got home, I didn't have time to update my usual computer. And let's see if I can make this work. So you can see this is daily. I can look at a weekly on the S&P. And that looks a little different, doesn't it? The weekly bongo's red. We already know that. We're just pulled in gently to the 17. So now the first thing I would do is I basically go into my OVI work just out of curiosity. And you should never do what you haven't looked at yet. But I'm going to open up, let's see if I can remember login. Hopefully my password doesn't show up. And sign in and go look at my OVI charts. And I'm just curious what the spiders will show, or the S&P 500. That's so good to be home with fast internet access. So again, this is a proprietary indicator, and it's pointing to the downside. And you can see in a strong uptrend, this OVI is very powerful. When the stock was basing, but a positive OVI more than negative, that suggested the market would break out to the upside. So I'm not getting any signal here at all. It's pretty flat line to a little bit negative, so that's not going to help me. Close this down. So I've got a pullback. I'm looking at this even before the futures. I made my comment that I think there's some more strength in this market than we realize. I might want to look down at the Dow Jones Industrials, and I see the same exact picture. All right, well, let's look at the NASDAQ. As you can see, a little bit stronger, sideways, not pulled down yet into the 17. Or I could look at the Russell 2000. And we can see, last week I was talking about we were coming sort of to a wedge, to the center of the wedge, and will we break out above or below, and we just went straight sideways. But we had an up week. This is the weekly chart. Let's go back to the daily chart. And you could see I've been talking that we were going to break out. Will we pull back to the 200? Or are we going to break out to new highs? We'll see how it tomorrow ends, not just what the futures are showing us. I mentioned biotech was weak last week, and you could see, unlike the rest of the NASDAQ, biotech has traded well below the 50 and had a very bearish candle and some bearish kahunas, although of note, the weekly bongo hasn't given up the farm yet. If I look at the dollar, I'm all about moving averages. And not only is the dollar in a weekly bongo sell signal, dollar failed here at the 50. And until it closes above the 50, I'm probably not going to be excited about the dollar. My question is, how low is the dollar going to go as the concern about the volatility in the marketplace and the news? The VIX, speaking of volatility, not been a good place to trade, at least instruments based upon the VIX, because the VIX hasn't really been moving. It is clearly higher at a baseline than it's been in quite some time. And that might be concerning. You can see the VIX spikes. All I can say how the spikes mean to me is that I don't like Guy. He made a comment that I've made to George. George and I don't always agree, George Lee. George is when the VIX is low, you got to go. When the VIX is high, it's time to buy camp. I don't think that's correct today. When the VIX is low, it doesn't give me a signal. When the VIX is rising, that's when I should be nervous and lightening up. And when it's falling, it's when I should be buying everything in sight. But I can make money buying and selling when the VIX is low. It's when the VIX is moving that I pay attention to it. And we can't get out of our own way on the VIX. I thought it would break up. I had some SVXY puts, and the half I took profits on, I made money, and the other half expired worthless, which sort of killed my margin, my profitability on the trade. Notice the weekly bongo is green, so there is a change here, so we'll have to watch that. Now, if the dollar's weak, gold should be strong. Gold might also be up because of all the news and the potential for the fascist victory in France. As you can see, gold is strong. If you put a weekly view on gold, you can see gold has been, bring some more, in a pretty significant downtrend since 2011. I've not been a gold bug. I have played some of these bounces. I thought gold was acting better and that perhaps gold would keep above its major moving averages, and it might be time to start buying more gold. Still may be. What I don't understand is if this is gold, explain this to me, why gold miners have failed at the 200 multiple times. So what was support on the way down becomes resistance on the way up. So I wouldn't be touching gold miners until I see them close above that descending 200-day moving average. And then silver looks a lot like the miners, struggling and to stay above the 50, but dropping below the 200-day moving average. So I look at the major indices, I see some hope. I really do. It's not as doom and gloom as they say on CNBC. And I had that comment before the futures. Now, I use some other tools in the market, and I sort of call it my 5-step market assessment. And it's funny, I kind of made that up one day, and it stuck, and people have actually called me asking where do they get the tools that I use. So I look at 5 things in 3 different time frames, and in about 5 minutes, I get another view of the market. This is the E-minis. I look at number 1, is it in a person buy or sell signal? It's in a daily buy. What's the color of the paint bar? Green means it's okay to buy or hold, I shouldn't go short. Red, I can short or hold, I shouldn't go long. And blue doesn't give me a signal. I often find that before a stock shifts from a sell to a buy signal, it will go from a red to a blue or a green to a blue, and that might give me a heads up that there's some change coming. That's the elder impulse indicator. The third thing I look at is where am I within my boundaries? When I get above the auto envelope from elder, the stocks have a tendency to go back in. The fourth thing I look for are these little red dots that tell me that there's potential for some MACD divergence or convergence if they're below. And the fifth thing I look for is one of my indicators, the high jump bar, where I look at how much extended are we compared to the highest extension in the last 200 days. And when it's above 95, I take notice. So, E-minis. It went to a buy signal on Thursday. It's green. It's within the envelope. There's no evidence of MACD divergence, and it's in the midline on the high jump. That's a daily buy. It popped up a new weekly buy today. It's a future, and it's been in a monthly buy. That's a bullish picture. I look at the Dow. Now, the Dow we know was weaker this week, and the Dow, if the market stayed where it is right now, and the Dow's up 134 points, so it's not nearly up as much as it was at 6 o'clock, but the Dow now has a new buy signal in a green. It's within the envelope. There's no MACD divergence. Its high jump is low, and you could see it's in a weekly sell, as I showed you earlier, but in a longer-term buy. If I want to look at the NASDAQ, these are the NASDAQ 100, but they do most of the movement in the NASDAQ. You'll see a stronger setting. You'll see a buy on Thursday in green. You do see some evidence of MACD divergence, and all that means is you're setting a new high here, and you're barely turning positive on the MACD. And you could see the MACD lines are coming down despite a higher high. That's concerning. That might suggest reduced bullish pressure on this and something that I have to watch. But you could see otherwise it's a bullish on the daily, and it never went to a sell here on the weekly or the monthly. And lastly, on the Russell, still get those futures on TradeStation. You can see we went to a buy signal on Wednesday, not on Thursday. Everything looks great on the Russell. You notice it's still in a person sell signal, but the bars have turned green. If it closes there, I suspect that you'll get a person's buy signal tomorrow. So that gives me an understanding of the indexes. And again, as I started this presentation, I told you I feel more bullish than the TV stations are telling me to be. I then go back into my spreadsheet view and I go to 07, which are the industry groups. And you could see in HGSI we have 173 different industry groups. And if I right click on any of them, such as home product stores, it gives me a list of the stocks in that industry group. Now, the power of HGSI is this thing called the view. And the view includes a filter, which filters what you want to have in this, and then a ranking module, which brings specific stocks to the top. So when I look at industry groups, I typically go down to my 2-day force. And force just looks at two things, price and volume change. And stocks that have huge volume or huge price changes have more force. Force is an Alexander Elder indicator. Today's price minus yesterday's times volume plotted, and he looks at a 2-day and a 13-day exponential moving average. So I created our own use for that, and we basically look at the 2-day exponential moving average as a signature of momentum, and I apply that to my industry group list, and the groups with the highest momentum come to the top. Since I'm a top-down investor, the most important thing to me is what is the market doing? The second thing is, if the market is bullish, which groups do I have that are moving up? And then within those groups, which are the best stocks? So interestingly, bank stocks came up to the top. That's a bit of a surprise. And let's right click on that, and we see that there's two banks that got in above the index. Why would I want to buy things that are underperforming? So let's look at these two, and let's notice they were up 6.8, 9.4% on the week. So these are regional banks. Does that tell you that perhaps regional banks are improving? So now I'm going to ruin this for you and bring up the rest of my indicators, and I'm not going to spend much time on them except to point out red is good, is bad, pink is bad, blue and green are good. I've added to my daily charts this thing here, which is the industry group in gray, and then Wilder's PSAR above and below. And we really don't want, I want to take something off that's I think will be problematic. So let me go in here and edit this. Let me take out what VPA stuff. Delete. Okay. All right. So here's KeyCorp. Here's a daily chart. Uptrend, pull back to the 50, a breakdown with the interest rates falling, and now it's moved back above the 50. It's got momentum coming in. Now, the market momentum, the Eurekas and Phoenixes are going to be in the center, and I added the Gil Morales' pocket pivots here. His Bible gap ups here are the third row, which you can't see well. The squeeze indicator, the MOBO breakout. So I can see a number of momentum indicators on the right edge and look at my stock price and the moving averages. So interesting. I don't love it. I like to see it break out above the 50, but it's certainly moving up. And then KeyCorp has broken above the 50, two pocket pivots, three kahunas in the last 4 trading days, coming out of a squeeze with a MOBO breakout and a Bible gap up. This is interesting. And this one I think is already in my buy watch, but I would add it to my buy watch. Next is the index. I don't care about that. So then I go right click back. I go, oh, the next group is steel producers. That's interesting. And I notice, let me make sure I've ranked by raw. So let's take a look at U.S. Steel. So I have a position in here. It's sort of got a collar on it. but here's a stock that pulled back hard down to the 200-day moving average. All my technicals up here are deeply in the red. There's no reason whatsoever to be buying the stock unless you think that steel stocks are going to make a move. Then I look up here and I see the next quarter and the following quarter earnings per share growth are outstanding. It doesn't have a multiple. That's because it used to lose money. And if I take the 67 cents of the last two quarters and I add the $1.24, so now you got $2 or so in earnings if these two quarters are met. And it's trading at a PE of 16, when right now the last time it lost money over the last several quarters, I see a stock that, if left to run on its own, and if the economy, the climate, the steel, tariffs, and different things settle down, here's a stock that to take out, but right now I'm not going to touch that, too low in its pattern. ArcelorMittal looks about the same. Steel Dynamics earnings are out. It's retaken its 50. It had a couple of pocket pivots and a kahuna. This is interesting, and I'm going to put that on a watch list. And then Nucor Steel is another one that looks similar. Now I'm curious, and this is how I use the OVI, is I'm going to filter it right away. And I'm going to pull up my OVI, and I'm going to type in here steel, STLD, and it's going to show me not much. So it's showing me a little bit to the positive, but really not a home run. What I want to see is a stock that's pulled back, that's setting up, and then my OVI actually leads the price up. What about U.S. Steel? Again, a little nubbing up, not enough to get me that excited. All right, I'm going to shut that down, right-click, and go back. And what do I have? Raw material for steel. That's really interesting. Vale from Brazil. Used to be one of the two stocks that were Rio. Sorry about that. So what do I see? Uptrend, pullback, sloppy. Everything's red. I'm not interested. But again, look at the earnings per share growth coming into the stock. It's going to make $1 and replace 24 cents. There's a lot of growth there. Cliffs, this was a big winner last year. It's in a downtrend. It's below the 200. I'm not interested. It too has some very robust earnings coming. Demand supply at 7.6. There's a lot of demand coming in for this stock. That's kind of interesting. All right, then I get to the index. Not really exciting here thus far. Internet media, a little bit more exciting. In fact, let's look at these because several of these are on my buy watch list. Facebook. It's my second biggest holding. I've been in it ever since I sold puts at around 60, and then the stock tanked, and I got the stock put to me. I was so pissed. I was underwater, and I still have the call put to me at 60. And since I got paid $5 premium, that's given me a pretty good base cost. I've just held on to the stock. I think Facebook is poised to go higher. Everything is green here. It's coming out of a squeeze. Multiple kahunas, a pocket pivot on Friday. Good earnings per share growth. I like Facebook, and Facebook goes into my buy watch. Google. You look at Facebook and you have a relatively tight stock uptrend, and you compare that with Google. It's all over the place. Hard for me to get excited by this. I don't own any Google now. However, Bongo just turned green. It's in a short-term uptrend. It has a pocket pivot. It also has earnings this week, so I would be careful. Weibo. This is one I'm looking at potentially purchasing on Monday. I've been in it before. Why am I interested in it? Yes, the red weekly Bongo is still red. That's bothersome. The earnings per share growth is outstanding. It had two pocket pivots in a row. It had a kahuna on Thursday, a PSAR reversal on Friday, coming out of a squeeze as well. And out of curiosity is how's OVI going to treat Weibo? I think I looked at this earlier today. Aha, this is what I want to see. So, Guy, if any of your team is actually watching this, it would be really nice if I could do that and magnify those dates and focus in on those dates, kind of like in Thinkorswim, and it's jumbled because the size of the resolution. So in Thinkorswim, if I do this, it allows me to capture and see more detail. But clearly Weibo has got positive OVI strength coming in. Weibo looks great. It goes on my buy list. And again, on all of these, I'll have to decide what strategy I take. Cena Corp, it's just, to me, it's too sidewaysy, and I don't have the sense it's about to break out. Doesn't make any money. It did have a kahuna. I passed on this one, but it's sitting right on support. Interactive, love the chart, clear uptrend, pull back to support. This is where I buy the stock, breaking above the 50 with a mobile breakout and a pocket pivot, volume coming in. Interactive Corp looks interesting as well. We just found where the interesting stuff was. Home product stores. Select Comfort, I don't know if it's a takeout. It had a 5-day movement of 30%. So it either had great earnings or it's a takeout. Earnings here say, yeah, probably had earnings come out. I'm going to skip that one, but let's look at Home Depot. Again, what is I call a Jeffrey stock? Uptrend, tightening pattern, which is even better. Sideways, pulling into the support, and then momentum. So out of a squeeze, I had mobile breakouts, a PSA reversal on Thursday, a pocket pivot, a kahuna on Wednesday. This is a beautiful breakout. It's expensive. Its multiple is twice what its quarterly earnings per share growth rate is. It's probably about as pricey as it's ever been. It's certainly the all-time high. And again, I like to go to my OVI charts and just very quickly see, are they seeing institutional strength in Home Depot? And they are. So here's a stock going sideways and building up underlying strength with the OVI. Home Depot, if I was doing a stock of the day, so far this and Weibo are the stocks of the day. Lowe's Company, a junior Home Depot, pattern looks very similar all around. Tractor Supply has been clobbered. So this is how I trade. I am a top-down trader. I run a number of scans, which I'll show you in a few seconds. I build a watch list, and now I cross-check them, which I haven't historically shown you with OVI. Semiconductor devices will be the last, and then we'll look at one more. A lot of these have pulled back a lot. The interesting thing is, so you can look at NVIDIA below the 50 in a downtrend, not interested. AAOI, great earnings and sold off, not interested in right now. Intel, well, it's too loose for me, but it's sitting right on support and had some momentum coming in. Acalero, speaking of sitting on support, had a high close doji here. Doji on Thursday, closed above it on Friday. But it's in a pretty deep doo-doo pullback, and it's a very loose pattern. I did put this on my watch list, OCLR, and I actually looked at it with OVI as well. And you could see that OVI is showing a little bit of strength on this pullback, and I like that. So here's another one that I liked. So I go through 10 groups, and then I end up with a list of attractive stocks, and I came up with 40 stocks that I liked, and these met various, before I say 40, let's make sure, 44 stocks that hit various criteria that I liked. Several of the ones are already sitting here that we mentioned. Home Depot, Weibo, the Acalero, Big Five Sporting Goods looked interesting. It's going to pop up a chart here. And again, I look all day long for pullback, uptrend, pullback to support, and a breakout. pulled back more than I like, but two kahunas in a row, two pocket pivots in a row, nice breakout here. Everything is green. And again, I screen with John stuff, and I also screen with OVI because I can find 40 stocks. How am I going to find the 3 that I'm going to actually try and play this week? And I use filters. This to me is a filter. And wasn't really impressed with the OVI here, but it's certainly positive, and the stock is breaking out. Now, one thing that I thought was interesting is if you look at the industry groups that I popped up, no surprise on the home product stores, Home Depot and Lowe's, not much in biotech or specialty pharmacy. They just don't look good. Internet media, I have a couple of those that made my watch list this week. The shocker to me was specialty apparel. And let's just take a look at Gap. I can't believe I'm going to fall into the Gap, but I think I may fall into the Gap. Speaking of fall, Gap's been killed. Here's a weekly chart on Gap, and it's dropped from 50 down in half to 25. It's gone sideways for weeks. This week, it looks like it's breaking out. It had pocket pivots, kahunas, everything there is green. It pays a 3.6% dividend. Its earnings are not any good. So let's just quickly take a look at my OVI, GPS, and see what I get. Yeah, this really struck me. Here's a stock that's been killed, and for the last several weeks, the GPS is building a strong picture, or the OVI is building. I'm very interested in the Gap. So what I've done then is I've now taken you through a top-down view. I've showed you how I use my tools to give me a sense of what the market is doing. I identified some of the stronger industry groups. If I go back to that 07 group here, go back to the 2-day force, you could see that the next group down on my list was specialty apparel stocks, and Gap was the second one there. And I think Gap, again, Home Depot, Gap, Weibo, those are the 3 stocks that have my interest the most this week. I keep a watch list of other stocks because, you know, who knows what the market's going to do. And I did empty out a lot of positions this week. I take this list and I filter it in TradeStation, and these were the ones that I came out that I was most interested in for this week. And you could see the 3 that I mentioned should be here. There's Weibo, there's Gap, and I thought Home Depot made it to this list, and there's Home Depot. And just to give you an idea of how I integrate this stuff with John's stuff in TradeStation, and yes, I am crazy, and yes, I do have a little bit of analysis, but not the paralysis because I make the trades. And let's just take a look at, Home Depot. So nice to be home where my internet is so much better. All right. This OVI thing actually is great. It works inside TradeStation, but I've got to have my regular resolution. So here's Home Depot, and I looked at it today, and clearly it's been in a big uptrend for a number of weeks. It's in a person weekly buy signal. It had a high close doji on the weekly. Its on-balance volume is going up. It had a PPS weekly buy on Friday. It's in a PPS daily buy. This yellow dot here tells me it's been in a squeeze now for several weeks. And on Friday, these are my dot indicators. It had a mobile breakout and a PSA reversal on Thursday. I like Home Depot a lot. And again, what I would be doing if it was a higher resolution, I would have also opened it up here in my OVI chart and be able to validate that it's got good OVI, which you can kind of see. But again, I had to dummy down my resolution, and hence it doesn't look very good. So on that note, this is what I do. I scan the market, I build a watch list, I test with a number of different phenomenon. And again, back to the guys from OPTIONSEASY, if any of you are watching, one of the things I mentioned, and I'm just going to show you it's a great strength within HGSI, is there is a thing called smart groups. And in smart groups, they have a number of pre-done scans. Every time I update the computer, my scans get updated, and that tells me the date they were updated. And these are some of the scans that I like. I like 3 times volume. I look for stocks that had a lot of volume come in. A lot of big moves are preceded by big volume. I have pullbacks to the 50-day moving average with a kahuna. So what I could do is, well, there's Cena. So what I'm looking for specifically here are going to be stocks that have been in an uptrend that pull back to the 50-day moving average and then had momentum. So here is Werner Enterprise. And it's not a very tight chart by any means. And again, these things are in the right place if I have my regular charting, my regular resolution. So since October, it's been in an uptrend. It pulled back. Let's get this in a daily. It might be more appropriate since it's a daily signal. So uptrend, sideways, pullback, and kahuna. So it had momentum in a breakout this week. This is not one I'm interested in. It pulled back pretty deep. And the only reason why it's close to the 50-day moving average is because it had a big gap up today. That's not going to do it. Masco. I think this one will look a little bit better. This is a stock I look for. It's clearly been an uptrend since November. It pulled back to the 50, and today, on Friday, it had a pocket pivot, a kahuna, momentum occurring with a breakout above the 50. So I have a scan that I can run intraday as well that will pull out stocks that are breaking out above the 50-day moving average with momentum. I also have one here, which will be stocks that are in a squeeze, and they're right below the PSAR dot, and I'm looking for stocks that haven't broke out yet that are about to break out. So let's look at Skyworks, tied very much to Apple, so it could be dangerous looking at this one. And so what you have here, or will have here, here's a stock that's in an uptrend. It's basing right above the 50, and this red dot is a PSAR dot. This is my get on a plane and go trade, because I spend a lot of time in the airlines. And what I find is I'm not necessarily on a good internet to make a trade, but let's say I really like this. So here's how I look at this trade. Again, I'd have to look further. Let's just do a quick check on OVI. And I could see not massively positive. It's been positive for weeks, okay? So that's enough. It's not a negative filter. So what I would do if I was interested, I see that the stock on Friday closed at 101.60. The PSAR dot is at 102.01. There is a trading system by Wells Wilder that I don't follow, but my assumption is if the stock trades above that red dot, it's going to convert to green and turn into support. It will trigger a buy signal in some program trading, and I might as well jump in as well. So I typically, before I get on my plane, I will stick in a buy stop somewhere above that PSAR dot. And then I'll look at this trade and say, where should I put the stop? Now, I could be very conservative, and I could say, you know what? I'm going to put my stop right below the 50-day moving average. So I'm going to buy it at 10, where's the PSAR dot again? So I was going to buy the stock at 102.25, say. And my 50 is at 99.26, so I could put my stop at $99. So it means $3.25 stop on a $100 stock. I love it because that's given me room to breathe. It has not been below that 200-day moving average forever, or 50-day moving average forever. And as long as the stock does not close above the 50-day moving average, I don't want to be stopped out. So to me, this becomes a very safe trade because I've got defined entry and exits. I can do conditional orders. Now, I will probably spend some time if I was taking this trade thinking about whether I want to do option strategies or buy stock, but I know my entry and I know my stop. I usually trade at a 1-to-1 target and take half off when I reach a equal move as my stop, and let the rest run with various other stop strategies for another moment. Now, the one concern I have is going to go up here and I see, nope, earnings are Thursday. That's why this isn't in my watch list, despite the fact it's a beautiful stock. But the neat thing is, not basically just about picking the trade, every stock in this group is going to look the same way. Many of them are going to be buyouts. And I find a lot of great stocks by finding stocks in uptrend, sideways, right below the PSAR dot. And unlike the pullback to the 50 and then a breakout, I'm buying stocks that haven't broken out yet. So on that note, again, I've introduced you to some things I learned this week from Guy Cohen. He doesn't heavily market compared to some people, but he does a lot of webinars, and I think some people really might think that this is may or may not be for them. I was very impressed with the meeting this week, and I have been using the OVI and some of his scanners for a while. I don't show you everything that I use for various reasons, including I will confuse you more than I confuse you already. But over the next couple of weeks, I'm sure I'll be introducing you some of the scans I do as well. Again, what I do is simple. It really is. I look at what the market is doing. Once I know the direction of the market, I look at which groups are leading to that direction. And then I find within those groups what are the leading stocks. I look for specific patterns, especially pullbacks, to support in an uptrend and then a breakout with momentum. I use various tools to scan them, various signals to identify them, and then I decide what the right strategy is to trade them. You all have a great week. Before I say goodbye, let's just take one last look at the futures. And the futures tell us that they are still, that can't be, that was a while ago. I know they sold off since then. Let's see. Well, sold off is a big term. Down a little bit from where they were, still very positive. So clearly the U.S. markets are looking positive over the what's happened in France. On that note, I'll say goodnight again. It was great meeting you, Guy, and anybody else that I met this weekend. And if you want, next week.